Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Razi. So for question 1A, there's two questions, which is construct SYDM depreciation schedule for the machine, and second, calculate the total tax liability that company has to pay. The statement say Dungun Food Factory bought a shumai processing food machine the last 2 years, which costs Rm52,000 with a useful life of 6 years. The installation cost is Rm2,700. The transportation cost is 3,300, and the salvage value were Rm12,000. And the company decided to sell the machine at the price Rm35,000 after 2 years of use. For the first question, we use the sum of digit method SYDM. So first of all, we need to calculate the annual depreciation using the formula given n bracket n plus 1 bracket divide by 2 and represent as useful life. So in this question, the useful life is 6. After that, cost of asset need to be minus with the salvage value, and the answer will be used to calculate the SYD for year 1 until year 5. So for SYD for year 1, in the bracket is 58,000 minus 12,000, and will be multiplied with bracket 6 divided by 21. So the method will be the same from year 1 to the year 5, but the only difference is the rate. The rate will be decreased one by one each year. For example is year 1. Year 1 rate is 6 divided by 21. And for the year 2 and for the year 2, 5 divided by 21. And will be decreased one by one each year pass. So as you can see in the table, the beginning value will be minus with the annual depreciation, and the answer will be put in the book value. As you can see, the annual depreciation amount is the amount that we gain from the calculation for the year 1 until year 5. So after all the calculation in the table, for the year 6, we should get the book value Rm12,000, which is the salvage value. Question 2. The statement say earning before tax Rm75,000, and the corporation tax rate is 35%, and capital gain tax is 25%. So 2. Tax calculation, these are the information we provide. So to get the total tax liability, first we calculate the gain on recapture depreciation, then use the answer to calculate the tax on recapture depreciation, and multiply by 35%, which is the marginal tax rate. Next, we calculate the tax on ordinary business income, Rm75,000 multiplied by 35%, and the answer is Rm26,250. And then to get the total tax liability, the answer on tax on recapture depreciation will be plus with the tax on ordinary business income answer, and get the total tax liability, which is Rm26,633 ringgit and 33 cents. Question 1B, Buritomo Crane Service Neighborhood purchased a new crane that cost Rm500,000, additional cost Rm10,000 for transportation, and the estimated last for 5 years with the salvage value 50,000. So in this question, we need to use the double declining balance method. So first of all, we need to calculate the DDBM rate for the annual depreciation, and the beginning value will be minus with the annual depreciation to get the book value. You can see in the table for the year 5, the book value is the 39,657 ringgit and 60 cents. we take the beginning value in the year 5, which is 63,096, will be minus with the 50,000, which is the salvage value, and the answer will be the annual depreciation for the year 5, which is 16,096.
Assalamualaikum, my name is Nur Amira Natasha binti Zamzuri. I'm gonna explain about question 2. Based on the question above, we need to calculate the expected rate of return, standard deviation and coefficient of variation for both projects. For the calculation, first we need to find the expected rate of return for both companies. The formula for expected rate of return or EV is total probability times with rate of return, which is the probability is 0.20 times with rate of return for project MCMC 17%. Make sure put the bracket, then plus next probability, which is 0.45 times 11% plus 0.35 times negative 6%. After that, calculate it all, then we get the answer. Do the same thing for project Cyberjaya. So the answer for expected rate of return for project MCMC is 6.25%, while for project Cyberjaya is 6.7%. Second is standard deviation or SD. Before we calculate the SD, we need to calculate the variance first. Formula for the variance is the total probability times with rate of return minus total of the expected rate of return square. So to calculate, just fill in the formula and you will get the answer for both projects. Project MCMC, the variance is 85.7875. We need to take 4 decimal. For project Cyberjaya is 10.71. Now we can calculate for the standard deviation. So the formula is square root the total of variance. Then we will get the answer and make sure it is in percentage. Standard deviation for project MCMC is 9.26% and project Cyberjaya is 3.27%. Lastly is coefficient variance Cv. The formula for Cv is the total of SD divided by the total of EV. So the answer would be 1.4816 for project MCMC and 0.4881 for project Cyberjaya. And make sure take 4 decimal. Next question is which project should the company accept? So based on the calculation that we made, QCQ Digital should select project Cyberjaya because the coefficient of variation for this project is 0.4881, lower than coefficient of variation for project MCMC, which is 1.4816. We choose the project with lower coefficient variation due to lower risk. For question B, first we need to determine the break-even point in quantity. The formula for break-even point in quantity is fixed cost divided by sales price per unit minus variable cost per unit in bracket. So the fixed cost is 560,000 divided by sales price per unit 280 minus variable cost per unit, which is 120. Then calculate it, we will get 3,500 units. Next is compute the ringgit sales volume the firm must achieve in order to reach the break-even point. First, take the fixed cost 560,000, divide with in bracket 280 minus 120, then close the bracket and then divide with 280, which is the sales price per unit, and then we will get the answer, which is 980,000 ringgit. Last question is, would the company profit or loss at sale on 20,000 unit? The answer is the company profit about 2,640,000 ringgit for sale on 20,000 unit, where 20,000 times with 280 then minus with 20,000 times with 120 plus with 560,000. So the answer we will get 2,640,000 ringgit.
Hi, my name is Ahmad Dini Shazim bin Ahmad Zamzuri. I will talk about question 3. Ramadan Corporation Industry is currently in the process of planning its capital expenditures for 2022. The following projects are available from Project A until F. Ramadan Corporation Industry wishes to determine its weighted marginal cost of capital before making any major decision. In making the required calculation, he has currently compiled the following data in a display table. As you can see, the sources of capital consist of long-term common stock, and preferred stock. Now, let's start answering the questions. A. Determine the breaking points and range of new total financing associated with each source of financing. How to find breaking points? BEP. The amount needs to be divided by the percentage of weight. So for the BEP long term, the weight is 0.4. The answer is RM 750,000 and 1.5 million ringgit. Next, BEP common stock. The weight is 0.5. The answer RM 1 million and RM 2 million. And the last one is BEP preferred stock. The weight is 0.1. So the answer is RM 3 million. B. Calculate the weighted average cost of capital WACC for each range of new total financing found in question A. So for the first range, WACC is 8.85. For the second range, WACC is 9.25. For the third range, WACC is 10. For the fourth range, WACC is 10.80. For the fifth range, WACC is 11.55. For the sixth range, WACC is 11.60. C. Construct the weighted marginal cost of capital Wmcc and investment opportunity IOS schedule. First, we need to construct a table as in the slide by arranging from the highest IRR until the lowest IRR in order to find the cumulative cost. Then we need to construct an investment opportunity schedule. As you can see, the graph is using the previous data. It shows how the size of capital budget affects the firm's marginal cost of capital. The cost of capital for new financing increases as the amount invested and financed increases. Last but not least, D. Which project should the company accept? Justify your answer. The company should accept project A, B, and C since the project's IRR are greater than WACC.
Hi everybody, my name is Amar. Next, I would like to present question 4, which refers to chapter 6 that we have learned before this. Chapter 6 is about financial structure and the use of leverage, but this question is directly asked about point of indifference. The question is, Raya Berhad present capital structure as shown on the following table. Currently, the company has 800,000 debt outstanding that charges 6% interest rate and 50,000 common stocks. Basically, this is current capital structure for the company. Next, the company is planning to raise an additional 1,200,000 capital to finance a new project in Puncak Alam next year. As you can see, there are two financing alternatives, alternative 1 and alternative 2. We have to compute all the information in order to identify the company Ebit. The first question is, calculate the Ebit indifference level associated with the two capital structures. So, Ebit at point of indifference, which means we want to find the company Ebit at that point. Whatever company choose, either alternative 1 or alternative 2, it will not affect the EPS. That means EPS for alternative 1 and alternative 2 are same. So the step is construct a table as in the slide and calculate all the information given. That means we have to compute the current capital structures for the company, alternative 1 and alternative 2 capital structures. And then we can identify the company Ebit by using the formula given and use the related information in the formula. For example, for alternative 1, the formula is Ebit minus I stands for interest, 1 minus T stands for tax, minus dividend, divided by N stands for number of shares outstanding. So we use the information at the last column as you can see on the table. Same goes to alternative 2, and then we solve the equation. At last we get the answer for the Ebit equal to 171,928.57. Next question is, calculate the EPS for both structures at the Ebit indifference level. So we have computed the Ebit in the previous question. At this point of Ebit, both alternative 1 and 2 will give the same EPS. To prove this, let's substitute the Ebit in the formula. So as a result, we get the same EPS for both alternative 1 and 2, which is 0.39. So next question is, we do estimate the Ebit, which is lower Ebit 100,000 and higher Ebit 300,000. As you can see in the table, for lower Ebit, EPS alternative 1 is 0.06, while while alternative 2 is negative 0.62. On the other hand, for higher EBIT, EPS alternative 1 is 0.99, while alternative 2 is 2.18. As you can see, this is the EBIT EPS chart for alternative 1 and alternative 2. Alright, then just take a look at the table. If EBIT lower than 171,928.57, EPS for alternative 1 is higher than EPS alternative 2. On the other hand, if EBIT higher than 171,928.57, EPS for alternative 2 is higher than alternative 1. The last question is, if the company expects its EBIT to be 600,000, which structure should the company accept? This is so simple question, just substitute the EBIT in the formula given. So we will get the answer. EPS for alternative 1 is 2.39, while EPS for alternative 2 is 6.38. So which structure should the company accept? The answer is Raya Berhad should accept alternative 2 because higher earnings per share.
Assalamualaikum and hi, my name is Nur Amira Azman Muhammad Azman and I will explain question 5, which is this question is under topic merger and acquisition. Aidil Berhad is planning to acquire Fitri Berhad. In a merger transaction, below are the balance sheet of the companies before the merger. First question is, calculate the exchange ratio if the merger terms are based on first, earnings per share, and second, market price of shares. The calculation for earnings per share is based on EPS share exchange ratio equals to RM1.80 divided by RM2 and the answer will be 90 cents. For this calculation, the formula we use is EPS DC divided by EPS AC. Next is market price of shares. Market price of shares formula is MPTC divided by MPAC and the calculation will be based on MP share exchange ratio equals to RM3.60 divided by RM8 and the answer will be 45 cents. Next question, based on the market price exchange ratio basis, determine the following. First, purchase price of Fitri Berhad. The calculation for purchase price of Fitri Berhad is RM8 times in bracket 45 cent times RM600,000 equals to RM2,160,000. Second is post-merger EPS for both companies. The calculation for this question is RM600,000 plus RM1080 divided by RM30,000 plus RM600,000 times with 0.45 and the answer will be RM2.95. For EPSTC, the formula is post-merger EPS for AC times with ER and the calculation will be RM2.95 times with 0.45 and the answer will be RM1.33. For this question, we use the formula EPS equals to NIAC minus with NITC divided by NOSAC minus NOSTC. This is the table for both companies before and after merger and what is the effects after the calculation. Last question is prepare a post-merger balance sheet under the purchase method. So for this question, we need to calculate to find a new figure of total equities TC, new goodwill, NOS co-receive, common stock, and also total share premium after post-merger. So, this is a new balance sheet after made the calculation. The amount for total asset and total liabilities should be the same, which is RM5,660,000.